This cohort of companies, I think, generally is overburdened with feature orientation and short-termism more than you would see in an era of reduced capital rather than excess capital. And what I mean by that is a lot of companies built a business or built a product that allowed them to show traction in the market faster. And typically those products that are easier kind of paths to market end up being features. They don't end up being platforms. So it's very hard to become a big business or to become a scaling business or to differentiate in a competitive market. That's a very general statement. But I think, when you miss out on the platform play, you start betting as an investor on a lot of the derivative plays that look like the real big company, look like the platform. I mean, think about how many companies try to look like some iteration of Stripe, or try to look like some iteration of Uber, or try to look like some iteration of, name your big kind of behemoth. And as a result, you get all these sort of feature-ish platform plays that have maybe a niche or some kind of, narrow kind of market opportunity. They got funded. Those businesses obviously aren't going to have the same valuation multiples of the winners in the market. And now, and they burnt a lot of money to demonstrate growth because so much of investing over the last 15 years has been momentum investing. And so they try to grow, then they try to get a higher valuation, investors plow more money in. Now the problem is that so many of these Series B, C, D, and E companies have a true market value. They're not a valueless company, but the true market value of them is probably less than the total preference stack of the capital that's gone in. So they're worth less.
Let me just make sure people understand that.
I'll just describe it. Yeah. So when investors invest, they have preferred stock. So they have a right to get their money back. So let's say a 1x liquidation preference, they invest $100 million. The company is worth 300. So they own 25% of the company after they invest, but they have a right to that $100 million first before common shareholders get paid. The problem now is that a lot of those companies may be worth less than the 100. They're not worth 400 anymore. They're worth 100. And you can see this play out in the public markets with that data set I shared with you guys a few weeks ago. Over 2/3 of companies now that have gone public since 2020 are worth less than the capital that they have raised as in the venture market. So if they were still private, they would be worth less than their preference stack. And that's where these companies start to unravel, because now the investors have to totally recap the company. The founders don't want to have all of their common wiped out. Now they own nothing. And there ends up being a very ugly scenario that happens with the board at that point on how do we wind this thing down? How do we recap it? What's going to happen? And that's usually where everyone starts to run for the hills. The founders, one or more of the founders leave and so on.
Friedberg, I have a question for you. So you mentioned this earlier, which I think was a really important point, but we didn't really touch it. Do you think there's going to be a reckoning inside of venture firms about recalibrating general partners?
100%. I mean, look.
And why? Sorry, just explain why.
Yeah.
Why?
So I think what's happened is over the last 15 years, to become a successful venture investor, you've gotten into the hot deals. The deals where, and hot deals, the valuations are typically climbing up. And, when the valuations climb up, that's an indicator that the company is doing well and you should invest. That's been the model for operating in the last 15 years. But the truth is that maybe just because the valuations have gone up and more money has gone in doesn't necessarily mean that that's a great business, or as Chamath points out, that you ultimately get a positive net return on that investment down the road. And that window's now closed. So the investors that have been trained, this is such a generalization, and I hate saying it because we have so many good, smart friends that work in venture. But generally speaking, there are a lot of folks who have come up who have been trained on this momentum investing model. And it's like day trading. The stocks are going up. Let's all put money into the stock going up. Instead of having a more fundamental approach to, is there real cash generation potential and scalability and platformability of this company? And as a result, you're going to have to see, I think, the junior partners that have come up and done well in this market.
Can I build on your point?
Well, they've done well on paper, but they haven't done well on distribution. So maybe that, Chamath, becomes the way you decide who's a good venture capitalist. Which of these companies actually returned capital at a peak market?
Well, I think Friedberg is really onto something. And he mentioned this before, so I got curious about this. And I went into PitchBook, and my team and I looked at all of the people, the humans in our business, that have generated more than $1 billion in distributions on a given deal. And there's 20 that have done that in our industry. Like, there's people that have made hundreds of millions of dollars once or twice, but there's 20 people that have made more than $1 billion more than once. Okay. And if you look, not a single one came up through the ranks as a pure engineer or product manager.
Right.
Everybody, 201, is extremely commercial in their background and their operating experience. Very few percentages of them were actually founders. A huge percentage of them were trained in banks and other places. So non-traditional, quote unquote, roles for what this current crop of GPs look like. Because we went through a phase where if you were a VP of product or a VP of design or a VP of engineering at a well-known startup, that was the most obvious onboarding into a venture firm. But if you just look back at the data, that cohort of people has actually never made money. Again, according to PitchBook.
That's fascinating.
And that's a really fascinating counterintuitive takeaway, which is that, and by the way, what's so interesting about that is Pat Grady, I think, had a tweet, and it just sums it up so cleanly because he just hired somebody from Co2. And the tweet was something to the effect of, this guy is the most commercial guy we've ever seen, something like that. And I thought that was so interesting because that is exactly what our heuristical analysis of this data was as well. Commercial people in venture are the ones that make the money.
So you look at a Fred Wilson, Michael Moritz,
Danny
Bill
Reimer,
Gurley.
Bill Gurley. They were investment analysts
I can
in
share you the
public
list,
markets before they became venture investors. Or Mike Moritz, who was an author.
journalist, yeah. Which is, a journalist is just an analyst. It's another, if you're a good journalist, it's another word for analyst. Yeah.
It was really, really interesting looking at that list. So like, there are people in there like Jim Getz, Alfred Lin, Danny Reimer, Jan Hammer, Fenton. So if you look at all of these folks that are just tier one people, and we know all of them, the one common thread amongst all those folks is that unbelievably commercial. And so, Jason, in a moment like this, where you have to really hold the entrepreneur's feet to the fire or be their partner to make extremely hard decisions, you have to have the ability to be respected by them in those moments where you can force a very difficult decision. And then separately, if you have to basically force liquidity so that you prioritize your limited partners, how do you do that while still managing the relationship with the entrepreneur? How do you know that you just need to cut your losses and get out? These are very difficult trade-offs that I think folks haven't been trained in doing, to David's point. So it'll be really interesting few years to see how these organizations
I think this
react.
goes to Sachs's point about, hey, the ecosystem, if it's hard, if it's cantankerous, if there's sand in the oyster, it could make the pearl. If you have a congenial relationship with, your product manager VC and everybody's champagne and caviar and high-fiving, maybe that's not as good as having a Bill Gurley, a Michael Moritz, and having a foil maybe who is putting pressure on the management team. Hey, we need to hit these numbers. Freeberg and then Sachs.
Yeah. Look, I think one counter argument here may be that there is this friggin' tidal wave of AI